KB Home's balance sheet says the company is worth almost $62 a share. The stock trades around 56. The market is pricing one of America's biggest home builders below its own book value, while the company buys back its own stock at a discount. So is this a value opportunity or a value trap? Let's open the actual filings and find out. First, the backdrop. KB Home's revenue peaked at $6.9 billion in fiscal 2024, then fell about 10% to $6.2 billion in fiscal 2025, with net income down roughly 35% to about $429 million. Housing affordability is squeezing the whole industry, and this builder is feeling it. Then came the second quarter of fiscal 2026, ended May 31st. Revenue fell 27% to $1.1 billion. Deliveries dropped 23% to 2,395 homes, at an average selling price of about $462,000, and diluted earnings per share collapsed from $1.50 to 43 cents. All of this comes straight from the 10Q filed July 9th. Here's the engine of that collapse. Housing gross margin came in at 15.2%, down from 19.3% a year ago. That's about 410 basis points of profitability gone, driven, per the filing, by price reductions, higher relative land costs, and lost operating leverage on lower volume. But part of this trough was a choice. A year ago, management deliberately pivoted back to its built-to-order model, selling homes before construction starts, instead of building on spec and discounting later. In the second quarter, 73% of net orders were built-to-order. Backlog grew 26% sequentially to over 4,500 homes. Build times fell to 100 days, the best in more than a decade, and the cancellation rate was just 12%. Management says the delivery trough is behind them. And the recovery case is unusually specific. Adjusted gross margin was 15.7% in the second quarter, already a tick up from 15.5% in the first. Guidance calls for 16 to 16.6% in the third quarter, and the full-year range implies roughly 17.3% by the fourth, a step-by-step walk built on operating leverage, a richer built-to-order delivery mix, and high-price, high-margin Bay Area communities starting to deliver. The segment data shows why the Bay Area matters so much. The West Coast is nearly half of housing revenue, about $511 million in the quarter, but earned just a 14% gross margin, the lowest of the four regions, versus 20.2% in the Southwest. If those new California communities deliver at healthy margins, the biggest segment stops being the weakest link. Meanwhile, management is acting on the discount. The company repurchased 1.4 million shares for $75 million in the quarter, an average price around $53.57, well below book value. Another $50 to $100 million of buybacks are planned for the third quarter, with $775 million still authorized. And here's what buying back stock below book does over time. Book value per share has nearly doubled in 5 years, from about $34 in fiscal 2021 to $61.93 today, while the share count fell 35%, from about 95 million shares to 61 million. So what is it worth? For a builder under book, frame it off book value and normalized returns. In a bear case, margins stall near 15%, returns stay depressed, and book erodes, roughly $43 to $50. In a base case where guidance holds and returns recover to around 10 to 12%, roughly 56 to 64. And if the built-to-order model restores mid-cycle returns and the stock re-rates toward the 1.2 times book where peers trade, roughly 70 to 77. At $56, the market is pricing the base case and giving no credit for the re-rating. These are implied values under stated assumptions, not price targets, and definitely not investment advice. The gate on all of it is affordability. 30-year mortgage rates sit near 6.5%. Builder sentiment is at 35, a 26th straight negative reading. Absorption slipped to 4 sales per community per month, and $5.7 billion of inventory, over half of it on the West Coast, is carried at cost. If pricing takes another leg down, the balance sheet this whole thesis rests on starts to erode. The bottom line, KB Home at 0.9 times book prices in stabilization, but no recovery. Watch 4 things. Third quarter, gross margin landing inside the guided 16 to 16.6% band. Backlog turning positive year over year, as management expects. The Bay Area mix delivering that fourth quarter step up, and impairments staying trivial. Check those boxes, and today's discount was the opportunity. Missed them, and the market was right all along. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai, link in the description.